Okay, hello everybody, and welcome to Investing with IBD, sponsored by Interactive Brokers. Today is February 10th, 2021. I'm your host, Arusha Paris, and today we have Sam Stovall on the show. Sam is an author and the Chief Investment Strategist of CFRA Research. Thanks for being here, Sam.
Oh, happy to be here. Thanks for inviting me.
On today's podcast, we're going to talk about the current markets. We are going to talk about the Super Bowl theory, and then we will end the episode with a few current ideas. So let's get right into the current market. The market is in a confirmed uptrend. We have 4 distribution days on the S&P 500, 0 on the NASDAQ. Sam, what are your thoughts on this market?
Well, the market just keeps wanting to go up. It's taking advantage of the stimulus that it's been experiencing, and basically hoping that we're going to get more of. The expectation, I think, is around $1.5 trillion for the Biden package that will probably make its way through Congress.
Okay.
But a lot of questions arise right now as to whether we are in the beginnings of a speculative bubble.
Yeah, and I'm not sure how many, well, in my opinion, I'm not sure how many questions there are when you see some of these stocks, they're going through the roof. It seems like they're going up like 30% a day. And of course, we had the whole short interest thing going on a few weeks ago. You do bring up a good point about this speculation. What are your thoughts on that? Because that doesn't happen that often, right?
No, not really. I mean, you do sort of think back to the 1990s with the tech bubble, but there are a lot of differences. I mean, back then we thought that tech was cheap, trading at 60 times forward earnings. Now we're looking at a number that's half that, and we're worried about speculation.
Oh, that's a really good point right there. So let's get in, because you've been doing this for a while now. Let's get into your background. Walk us through how you got to your position as Chief Investment Strategist at CFRA Research.
Well, sort of a circuitous route. I went to a Division III college called Muhlenberg, and I was going to be a social studies teacher. I was going to teach social studies on the secondary level, meaning high school and junior high. I was going to coach football, and I was going to grow a potbelly, and I've only accomplished one of those goals.
Oh, that's excellent. And so then how'd you end up getting into the market as opposed to being in a teacher in high school in social studies?
Well, first off, the baby boom bubble had already worked its way through the school system when I graduated. So believe it or not, I had listened to my father and took some computer courses and some business courses, economics, statistics, and so forth, and was then able to find a job at Control Data, a company similar to IBM, selling and installing computer time sharing systems. Then I went to NYU, got my MBA at night, and decided, I think I do want to work on Wall Street. And my first job was at Argus Research. And then after that, moved over to S&P.
And your father was also on Wall Street, right?
Correct. He came to Wall Street back in 1953 at E.F. Hutton and was there for many, many years. And those who have enough tenure on Wall Street to remember, Pop was one of Louis Rukeyser's elves on Wall Street Week.
And that's a really cool little story right there. So you were working at S&P 500 or at Standard & Poor's, sorry. And how long were you there for?
I was there for more than 27 years. I'm still trying to figure out if that's a felony or a misdemeanor. But in October of 2016, S&P decided to get out of the business that had started back in 1860. There really was a guy named Henry Varnum Poor who wrote research reports on railroads. They merged with the Standard Statistics Company in 1941. Were thinking about calling themselves Poor Standards, but then decided, no, maybe S&P would be better. But S&P decided we want to focus on ratings, indexes, and data. And so they sold the equity research department to CFRA, which is an independent equity research firm that's been around for 25 years.
Okay, and so you've been there for now, what, 4 or 5 years or so in that position?
Correct. 4
Okay.
years.
And now one interesting thing is you had a chance to actually teach, right? You actually got to satisfy that other ambition that you had years ago. You got to be a professor for a little while at a college.
That's right. Because I got my CFP designation back in the early 1990s, a friend of mine said, "Hey, Sam, would you be interested in teaching a financial planning course at Marymount Manhattan College?" And I said, yes. And his wife, who was the head of the finance department, said, "Well, what are his qualifications?" And my friend said, "He's a CFP." And she said, "Done." So I taught for 2 semesters. And then she gave me the bad news that I was not going to be invited back. And I said, "What did I do wrong?" She said, "Actually, on the contrary, you did too right, because now the tenured professors are fighting over who's going to take your concentrated winter and summer courses." So I guess I left with a badge of honor.
That's right. You proved that there was actually a need for students to learn about financial planning and finance in
Exactly.
general, I guess.
Exactly.
So at as a chief investment strategist, now have there are a number of analysts working in the group. Uh, how do you work with them? How do you kind of synthesize all of their reports that they're coming up with?
Well, what I try to do is add value not only to our clients, but also to our analysts. I'm not going to tell them anything they don't already know from
Mhm.
a fundamental perspective about the stocks, industries, and sectors that they follow. But what I do offer is some rules based investing that they can then apply to help them make better timing decisions. I like to say that fundamentals tell you what, but technicals tell you when and how far. And I sort of say, well, quant sort of does that as well. So
Mhm.
I'm a big believer in momentum, in correlation, and in seasonality. And so I try to put together models and ideas based on those that help our clients as well as our analysts.
Yeah, and that does bring up a good point where the tech route and the quant route, obviously that's always really interesting to hear because a lot of people who go into Wall Street, they are strictly fundamental. That they're going off the valuations, but doing that hybrid, what really kind of inspired you to explore some of those other routes?
Well, I think it's because since I really was not going to be offering any fundamental guidance to our analysts or our clients, my thought was, well, I can either go technical, I can go quantitative.
Mm.
And then I read the book. There were two books that really influenced me the most. One is The Stock Trader's Almanac.
Yeah.
Those who are not familiar, it's basically a lot of putting the stock market's actions to the calendar, what normally happens, et cetera. And it's where you can also go to find many old sayings that are found on Wall Street and whether they still have applicability. I also read a book called let's see, What Works on Wall Street by James O'Shaughnessy,
Okay.
where
Yeah.
he went back to 1950 and looked at both fundamentals and technicals and said, what works best? And from a technical perspective, he was saying from a momentum viewpoint, look to those groups that have the highest momentum, not the lowest momentum. So I started doing work on that to substantiate what he said, but also to try to add to it.
Yeah. And so now, there a lot of times, and one of the truisms in the market is sell in May, go away, and the get yourself by. I can't remember. Drawing a blank on the October one, but you really want to be buying from October to April, selling in May, go away. But last year it didn't necessarily work out that way, right?
That's right. Well, the old adage is sell in May and go away. Do not return until St. Leger's Day, which
Yes.
is a horse race in England in late September. Uh, so why is it that we get out in May and then get back in the beginning of November? Well, it's also because investors get spooked by October because 5 of the last 10 bear markets ended in October. It has about twice the volatility as the average for all 11 other months, et cetera. So investors basically say, you know what, I'd rather get back in when things calm down. And also the Stock Traders Almanac talks about that with the best 6 months of the year, November through April. So I have embraced the sell in May idea, but with a little bit of a twist. Instead of saying retreat, I recommend that investors rotate. And in a book that I wrote called The 7 Rules of Wall Street, one of those rules is sell in May and go where? And the answer is from November through April, you want to be leaning cyclically, technology, consumer discretionary, industrials, and materials. Whereas May through October, you want to be leaning defensively, consumer staples and healthcare, because I guess as the old saying goes, when the going gets tough, the tough go eating, smoking, and drinking. And if they overdo it, they have to go to the doctor. So traditionally, you have weak periods of uncertainty, at least in the third quarter, and especially in September. And so investors say, you know what, maybe it's best that I end up being on the sidelines. And the returns have borne that out. Since World War II, the average price change from May through October has been less than 1.5%, whereas from November through April, it's been close to 7%.
But last year was a little bit different, right? And it was more
Yes.
of what you call a bizarro market.
Yes, to borrow from the Seinfeld episode, bizarro means upended. And what happened was that normally you have a good cyclical move from November through April. But as we entered the beginning of 2020, COVID struck, and we ended up having gravitation toward a lot of the defensive areas. The market went into a 34% bear market in a record 33 calendar days. So it basically upended the tradition of being in the cyclical sectors through April. But then when the Fed started cutting interest rates, promising to do whatever it needed to be done, then investors went right back into equities and gravitated toward the more cyclical sectors and entered into that V-shaped recovery.
Mhm.
So it was the defensives that did poorly as the market recovered from what it lost, getting back to break even, by the way, on August 18th, the third fastest on record of recouping a bear market loss.
Wow, yeah, last year just really once again proved that anything can happen in the market, and so you always have to have a strategy.
Sure. Well, it's a good example that you really never want to be totally out of the market, because think about it. 1.5 annualized is better than you would get in cash. And also, if you engage in the actual rotation, then you'd have to be paying ordinary income taxes because it would only be a 6-month holding period. So I say, no, you're better off sticking with stocks. So you're always in the market. It's like saying I'm at the amusement park, but I'm not on the roller coaster the whole time. Half of the time, I'm in the merry-go-round or the teacups.
Yeah, I like that. Well, of course, I don't like the teacups very much, though. So the market is in an uptrend. Growth stocks continue to hang in there, but remember, we are still in earnings season. Let's take a quick break, but when we return, we are going to talk about the Super Bowl theory. We'll be back. Build a balanced portfolio with Interactive Brokers fractional shares. Now you can invest in the stocks that you want, regardless of share price. Pick any available US stock and decide how much you want to invest. It's that easy. Interactive Brokers offers fractional shares on more US stocks, ETFs, and ADRs than any other broker. Start investing today with fractional shares. Learn more at ibkr.com/fractions. Sam Stovall is our guest on Investing with IBD, sponsored by Interactive Brokers. Okay, Sam, let's first start off with what we were talking about in the previous segment: seasonal rotation, and you have a Pacer ETF, right? That is based on that.
That's right. I did a lot of traveling with S&P indices to financial forums, and Pacer ETF representatives also happened to be in the audience when I was talking about this seasonal rotation strategy. And they decided, hey, let's create an ETF based on this strategy, so that because it being in an ETF, you don't experience the tax consequences as you would if you did the buying and selling on your own. So SZNE is the ticker for this seasonal rotation strategy. And you can learn more about it at paceretfs.com.
And okay, so they're essentially what you were talking about in the previous segment of rotating from defensive stocks to growth stocks based on the seasons. They're automatically doing it throughout the year.
Exactly. So October 31st, they take the entire portfolio, divide it into 4 equal parts, and populate those with the companies in tech, consumer discretionary, industrials, and materials. And then on April 30th, they sell those stocks, and then they split the portfolio into 2, 50% in consumer staple stocks, 50% in healthcare stocks. So you're always invested. It's just that you're either leaning cyclically or defensively.
Yeah, and it does bring up another question. I'm sure that you've seen this too. It's last 10 plus years or so. It's just been amazing at how many ETFs, how many different strategies that based that are enacted by ETFs are out there these days. Versus, before that there were a lot of mutual funds, and that was kind of the main way for the passive investing. What are your thoughts on that kind of growth right there?
Well, I think the growth is there because of the flexibility that the ETFs offer over the mutual funds. ETFs, you can buy and sell multiple times during the day, whereas mutual funds are only bought or sold at the end of the day. Also, and this is most important in my perspective, at the end of a year, you could have a down year for a mutual fund, but still get hit with a large capital gains tax consequence. Whereas with an ETF, most of the time you have no capital gains exposure at the end of the year. It's only when you sell that you then have either long or short-term capital gains that you have to pay tax on.
Oh, I mean that is a great point, and it makes a lot of sense why that instrument has really exploded over the last 10 years. So let's get into, this was actually perfect timing here, but let's get into the Super Bowl theory. As we know, the Tampa Bay Buccaneers won a few days ago the Super Bowl, beating the Kansas City Chiefs. Walk us through that. What does that mean when an NFC team wins?
Well, this is the Super Bowl indicator was created by a gentleman named Leonard Koppett back in the early 1970s, and he noticed, gee, whenever a team from the old NFL, now in the NFC, won the Super Bowl, the market went up, and whenever an old AFL team won, then the market went down. There were a couple of asterisk teams, such as the Pittsburgh Steelers, which were original NFL teams, are now in the AFL. So they were counted as if they were still in the NFC. So basically, NFC, the market goes up, AFC, the market goes down. And it did fairly well. But then Leonard sort of stopped following it when it hit a dry spell. And then my father picked it up and really started running with it for quite some time. And now it seems as if it's a Wall Street favorite, showing that Wall Street does have a sense of humor because there is correlation without causation. But it's just something fun to talk about and to write about every year.
And so with Tampa Bay winning, 2021 should be a pretty good year in the market.
Yes, the average frequency, meaning that if it pointed to an up year, this indicator was correct 84% of the time since inception. Now, whenever it pointed to a down year, because the AFC team won, it wasn't as good. It was correct only 53% of the time. But when you look at the price change, whenever an NFC team was the victorious, implying that the market would go up, not only was the batting average at 84%, but the average price advance was 11.7%. So you had a very strong price performance when the NFC team won.
Yeah, well, you might need to modify that to add when Tom Brady wins. Yeah, how does the market react to?
That's right.
Now, so that's one really interesting and fun kind of correlation to look at. Now, another one, and we had Jeffrey Hirsch on a few weeks ago from the Stock Traders Almanac, and this is before all of the trifecta was completed. We had 2 out of 3 trifecta when Jeff was on the show, but the third part, how January ends, the January barometer. Unfortunately for the S&P 500, we finished down a little bit, so that's 2 out of 3.
Right.
Any thoughts on that?
Yes. Well, first off, I owe a lot to Jeff and his father, Yale. I've learned a lot from the Stock Traders Almanac, gives me something to write about quite frequently as well. But the trifecta you're talking about are, one, the Santa Claus rally. We did have an up signal there. That's the last 5 days of one calendar year, beginning 2 days of a new calendar year. Then we have the early warning signal, the first 5 days of January. And then you have that followed up with the January barometer. As goes January, so goes the year. Well, January was down 1.1%. So while the first 2 were up, January was down, but it is not as bad as it might seem.
Okay.
Historically, whenever that has happened, the market has continued to rise, an average of 4.1%, and was up 73% of the time. So the batting average was not different at 73% of the time, but the average price change was essentially cut in half. So
Okay.
it usually goes from a great year to a good year.
Okay, and, I'll take that, especially after last year, how strong that year was. Well, 2021, if it
Sure.
goes, yeah, if it goes half of that, that'll still
Right.
be
I'll
pretty
take it.
good. Now, so let's talk about just bull markets, right? We had that quickest bear market, as you mentioned earlier. On average, what for Investors Business Daily, on average, we look at bull markets. They're around 3.5 years long, and so hopefully we're just in year 2. We're about to start year 2 of this bull market. What are your thoughts on that, or just kind of the length of bull markets?
Sure. Well, actually, bull markets last longer than 3 years. 3
Okay.
years is actually the third year is a very important year because a lot of bull markets have suffered early demises in the third year. But on average, because we had the most recent one last 10 years, actually closer to 11 years, what we find is that bull markets last about 5 years plus.
Okay.
So what it says is that on average, we end up advancing an additional 3 years after recouping all that we lost in the prior bear market. So
Wow.
we got back to break even on August 18th
Hmm.
after suffering that 34% decline in only 33 calendar days. So history would imply, but obviously not guarantee, that we have at least until the third quarter of 2023 for this bull market to remain intact. Doesn't mean we can't have pullbacks, which are 5 to 10% declines. They
Yeah.
happen on average every 9 months, or corrections, 10 to 20% declines. They occur essentially every 24 months.
Mhm.
But what is most important, in my opinion, is the speed of recovery. On average, it's taken only 1.5 months to get back to break even from pullbacks, 5 to 10% declines. And believe it or not, only 4 months to recoup all that we lost after declines of 10 to 20%. So my advice to investors is you are better off buying than you are bailing during market declines like that.
Yeah, when you are in strong uptrends, the buy the dip, buy on pullbacks is always a good strategy. So that's great to hear. Hopefully, 2023, I'll take it. That would be
Sure, it's
that
like
that.
the 7% solution. The average pullback is 7%. The average
Mhm.
correction is 14%. The median bear market is 28%. They're all divisible by 7. So, gee, maybe
I like that.
put money to work at every 7% threshold.
And you have somehow found a way to tie it back into football, which I really like. Because so let's talk about relative strength, because part of your strategy and part of the way at your firm and how you look at it is you're looking at relative strength and the momentum, as you mentioned before, and you also have a sector scorecard. Talk about some of those concepts there and why those are important.
Sure. Well, the first off, from the book "What Works on Wall Street," looking at relative strength, what James O'Shaughnessy showed was that the best look back period was 12 months in terms of consistency of beating the market. And I know that IBD looks at something similar. So
Right.
really, we're just sort of preaching to the choir here.
Just
But
great.
but what I do is every week I put together an S&P 1500 scorecard. Now the 1500 consists of the large cap 500, mid cap 400, small cap 600. There are 11 sectors and 147 sub-industries. So with each one of these sectors and sub-industries, I give a score 5, 4, 3, 2, 1, like a movie or restaurant review. 5 is best, 1 is worst. And it's a normal distribution. The best 10% on a rolling 12-month basis are given a 5. The next 20% get a 4. The middle 40% get a 3. The next 20% get a 2. And the bottom 10% get a 1. And obviously the question is, how well does this work? Well, going back to 1996, which is as far back as S&P has sub-industry level data, while the market was up 7.8% on a compound annual growth rate basis, the top 5, meaning the top 10%, those ranked 5, scored 13.5%. Those ranked 4 got 10.8%. Those ranked 2 were 6.5, and those ranked 1 were 6.0. So in a sense, like whitewater rafting, let the market take you where it wants to go, has proven pretty profitable over this near 25-year period.
No, and that's exactly what we've found in our research too. So let's take a quick break, but remember, knowing where you are in the market cycle and also apparently knowing who wins the Super Bowl can help you improve your success in the markets. Coming up next, we are going to go more into this sector scorecard, and we will also talk about a few ideas. Stay tuned.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200, or much more if you're trading big bucks.
We are back with Sam Stovall on Investing with IBD, sponsored by Interactive Brokers. Okay, Sam, let's continue with the sector scorecard, and we can generate some ideas from that too. Let's look at one of the later ones that you've had here with the S&P 1500 sub-industry group, and talk about some of the ones that have gotten some 5 stars, please.
Sure. Well, first off, this sector scorecard is found on our MarketScope Advisor platform. We offer free trials to our research. If you go to CFRAresearch.com, you can sign up for a free trial and you can find this sector scorecard. If you're too cheap to try a free trial, go to spindices.com and you can find the scorecard for the S&P 500 free of charge. So this way you don't have to buy anything. You can get the S&P 500 scorecard, and there too you find the relative strength rankings for the sectors and sub-industries. But what I'm finding is that it's in many ways it's still consumer discretionary, it's still technology, but also a smattering of materials stocks in there as well. Mm-hmm. So my most recent report called EPS Optimism, the final area, if you will, of that report was talking about revisiting this relative strength ranking. And those groups with the highest rankings, I came up with stocks that serve as proxies for these sub-industries. So companies like Deere in the agricultural and farm machinery area, FedEx in air freight and logistics, Dana Corp in auto parts and equipment. Best Buy is in computer and electronic retail. Freeport-McMoRan doing very, very well in the copper space. Yeah. A name that you really don't think about too much, Eastman Chemical in the diversified chemical category is holding up quite well. Names you might not be surprised to hear about, eBay in internet and direct marketing retail, KLA Corp in semiconductor equipment, and Apple in the tech hardware storage and peripherals group. So a lot of names that are well known, not so well known. There were more, but I figured I wouldn't overload you with names. And
we have Apple up right here, and this is a stock that's been coming up on our screens plenty of times. Now, their relative strength actually for us is a little low right now. We have a relative strength rating of a 67 on it. So over the last 12 months, it's only outperformed 67% of the stocks in the database. But I think that's more a reflection of how crazy this market is more than anything.
Well, or maybe what you say is you could use the scorecard to get an idea as to
Yes.
what groups are doing well. And then you could go dive into the IBD individual company rankings to cherry pick what is in there.
Exactly.
So, there are a variety of ways. What I did was I picked those that have the highest stars ranking. That's CFRA's stock appreciation ranking system. So in that case, I just defer to the analyst. But if you wanted to carry the momentum a little further, you could look at the scorecard for a sub-industry idea and then look at the IBD for the individual stock.
Yeah, and that brings up a really good point of really fitting or finding a strategy that fits your personality, right? And Sam, when we were talking earlier a few days ago, yeah, you were talking about the emotions of investing, right? And how that can throw, and we all know this. It's like how it can just throw you off. Talk about how you've managed that. Yeah.
Sure. Well, the best bit of investment advice I ever got, believe it or not, came from Clint Eastwood. When he was playing Dirty Harry in the movie Magnum Force, he kept mumbling through grit teeth, "A man's got to know his limitations." So I was thinking, well, what are my limitations? And my ego will only allow me to admit to 3. I am so impatient, I get upset if I miss a slot in a revolving door. I am so indecisive that my favorite color is plaid. And I am so emotional that in this day and age of instant information, I can experience both fear and greed at the exact same moment. So now that isn't necessarily bad. What's good is if you acknowledge what your weaknesses are and then try to work around them, extract them from your decision-making process. So that's why I like the Stock Traders Almanac. That's why I like James O'Shaughnessy's work or any other work where it's rules-based.
Yes.
So in my book, The 7 Rules of Wall Street, there are 7 rules that are old sayings like let your winners ride, but cut your losers short. As goes January, so goes the year. Sell in May and go away. And what I did was I went back and I said, do these adages still work? And if so, how would you employ them today? And very simply, that's what the scorecard does. The let your winners ride is basically say every month, look back 12 months and own those that are in the top 10%. And basically throw out those that fall out. And over time, you will end up outperforming the market, realizing that it doesn't work every year. It's more like outperforming 2 out of every 3 years. And that you do have dry spells, like the Super Bowl theory. It has not worked over the last, 5 years or so. But my belief is that Murphy's Law applies to investing as well. The year you give up on a time-tested strategy is the year in which it'll start working all over again.
Yeah, no, it is amazing at how well that works. Or even if you give up on a stock, you're like, oh, this is never going to go up. Right when you get out of it, there it goes. It takes off without you, and you're kind of just left behind. And so with going back to that rules-based approach, because that's exactly what we do here at IBD too. One thing is that what I've learned over the years is that you're following a mechanical approach as much as possible, but the emotions never truly go away, right? I mean,
Right.
talk about a time maybe where you let the emotions get the best of you in investing. Can you recall a time recently that you did that?
Oh, sure. And actually, I'm going to mention the ETF again. And my disclosure is I own the ETF and I benefit should people buy it. But the
I'll pull it
ETF
up right
being
here.
SZNE, basically, I find that people can be their own worst enemies. And even if they follow a rules-based strategy, it is human nature to want to overrule the rules.
Yes. Yeah.
Because here we were in 2019, and we had come off of the near bear market that ended on Christmas Eve of 2018.
Right.
We call it a near bear market because on a closing basis, it did not eclipse the 20% decline threshold.
That's right.
So here we were, end of April, the market was soaring ahead. And I would have said, well, gee, I'm not going to switch into the defensive sectors because they're going to get crushed, because the market's going to continue to go up because the momentum is there. But the strategy, the SZNE ticker ETF moved into defensive, and wouldn't you know that May ended up giving back a lot of the gains that we saw in the first 4 months of the year. Then we were looking at defensiveness in that May through October period, and weakness continued into late October. So I'm sure a lot of people said, well, you know what, I'm not going to get out of the defensives because things just don't look good at all. Yet the strategy rotated into the cyclicals, and at least until the COVID crisis struck, it was the wise move by basically following the rules and not trying to overrule the rules. So I think in general, rules are there for a reason.
Yeah.
It's almost like saying, if you're not going to follow your doctor's advice, then why go to the doctor?
That is a really good point, but a lot of people do that, right? And
Sure.
now and it does, as you're explaining that strategy, it really brought up another question, or really just kind of to get your thoughts on this. I think, and we say this, and I'll say this to people too, you really have to pick a strategy and stick with it for a while too.
Yes.
Right. So yeah, talk about that.
Well, you've got to stick with a strategy that fits your personality.
Mm-hmm.
Let's say, like I was saying, you don't want to be on the roller coaster the whole time. Well, then maybe half of the time you want to be in the merry-go-round. Okay, well, then you do want something that switches maybe every 6 months, like SZNE. Or maybe you say, no, I want to set it and forget it. Well, a strategy called what I call my free lunch portfolio is 50% tech, 50% consumer staples. Because believe it or not, since the inception of these sectors in 1990, what we find is that the compound annual growth rate for the strategy exceeded that for tech at much lower volatility. So not only did you get an absolute performance that beat tech, but you got a risk-adjusted return that crushed tech by itself. So let's say you say, I want exposure to tech, but at the same time, I want some exposure to defensiveness. Well, that's the free lunch portfolio. If you want to be more active, however, but still take a balanced approach, you could look at what I call my barbell portfolio, which at the beginning of every year, you buy the 10 worst performers from last year and the 10 best performers from last year. And when I say performers, I mean the sub-industries in the S&P 500. So, what you could be doing is basically saying, yes, I like agricultural and farm machinery, air freight, a lot of those names that I had mentioned.
Right.
But you know what? Last year, airlines, hotels, resorts, retail REITs, the oil and gas sector just got crushed. So maybe really I should be buying into those as well. Well, that's what the purpose of the barbell portfolio is. You let your winners ride from last year, but also buy low, sell high from last year. And through today, the bottom 10 sub-industries are up 12.9% versus 4.5% for the market, and the top 10 are up 8.5%. So far, so good. The strategy is working pretty well.
Yeah, no, that is really interesting, and once again, I mean, there really is a strategy for everyone. You just gotta take some time to figure out your own personality there. And you mentioned another really important thing for investors is the volatility, right? So there are plenty of investors, and probably I would say even maybe the majority of investors, they might even be willing to sacrifice a little bit of return in return for less volatility, because that fear, once again, can scare people out.
Oh, and I'm certain that fear is a greater motivator than greed,
Yes.
because what do we say? The stock market takes the escalator on the way up, but the elevator on the way down.
Yeah, I think that's the nicer version these days. I think there's a worse version before, but I think that's good, right?
Sure. And so the thought is, well, obviously, people are more worried about losing money. I always found it interesting that, like with the financial crisis of '07 through '09,
Mhm.
you check your sister-in-law theory, which is the minute she gets out is the minute that you know that the bottom is in place.
It's
And
true.
the flip side is your brother-in-law theory that, if he gets out at that time, every advisor has one client that ends up being their barometer, male or female, young or old. There's
Hmm.
one person out there who has zero tolerance, and they're usually the one that wants to sell at the bottom.
Yep.
So my feeling is, have a strategy not only for when the market is going up, but what are you going to do or not do when the market goes down?
Yeah, and going off that, just to being aware of hearing normal people, how they react to the stock market. I'm sure you're hearing this. I've definitely seen it. I know others have experienced it too. I'm starting to get phone calls from relatives, from other friends I haven't heard from in years and years, and they're asking about the stock market. How do I get invested in this?
Exactly. Yes.
Right?
I have two nieces who have never invested before,
Yeah.
and they asked me, Uncle Sam, I want to get in the stock market. What do I do?
Yeah.
And all I could think of was Joe Kennedy or Bernard Baruch getting advice from their shoe shine person.
Yes.
So yeah, that is a concern. We'll look back. We will look back not only at those indicators, but we'll look at the market cap to GDP at 124%. We'll look at the Russell 2000 being 40% above its 200-day moving average,
Wow.
which is the
Wow.
highest on record.
Wow.
You'll look at 98% of the sub-industries in the S&P 500 trading above their 200-day moving average. Um, you know, every time we've had a decline of 10% or more, was preceded by that magnitude of sub-industries above that threshold. But if you remember your logic 101, not every time that we reach that threshold did we fall into a decline of 10% or more.
Hmm.
But every 10% or more, it's like all trout are fish, but not all fish are trout. So
Yes. I mean, yeah, you kind of keep in the back of your head, because there are obviously a lot of sentiment indicators are to the extreme, or were to the extreme. Maybe this recent pullback that we had a few weeks ago resolved a little bit of it, but you always want to keep those in the back of your head, but you still listen to the market, and let the market guide you.
sure, absolutely.
So there are a few ideas that are worth considering, and a lot of Wall Street wisdom here. Thanks, Sam, for joining us today.
Oh, my pleasure. Had a wonderful time. I hope you invite me back.
Absolutely. Next week, we will have John Nigerian returning back to the show. John is the co-founder of Market Rebellion and a regular guest on CNBC. So that's it for this week on Investing with IBD. I'm Arusha Paris, and thanks for listening.
And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.